Okay, so once again, we're going to be looking right into chapter 6, point 1, point 2, and point 3. So with this being said, right, notice this, that we have a particular type of sales. Now, this is dealing with periodic sales, because if we have periodic inventory, this is exactly how we journalize our sales. Because one thing that we've been noticing lately is, why isn't that we record our sales when we are dealing with periodic inventory? Why don't we count our sales? And this is exactly why. Okay, so again, periodic sales. Okay, of course, what is sales in general? It goes hand in hand with the nature of a business, right? Our whole purpose is to take the natural resources and provide either a product or service for our customers, right? So in general, the main idea is that we're trying to get money. We're trying to make money, okay? So here again, how we make money is by selling goods and services, all right? And that's what our primary class is about, is being a merchandising inventory. So therefore, we need to set a few things. We need to sell products for cash, so we need to create some kind of selling price. Now, what we've been doing is every time we make a purchase, right? Notice is that our purchases are, I don't know, roughly $1 for each item, right? And then we add the freight on top of that. Now, what a selling price entails is it's going to be the cost it took for you to purchase that item plus a profit margin. Okay? So remember, the idea is when we want to make a profit, the purpose of a profit is to make sure that you set a price point that allows you to cover all of your costs, but also make extra money on the side. So if I bought something for $1, I definitely want to sell it at $5 so that I can take a $4 profit, and then that $1 that it cost me to purchase that item is going to be my expense. So that at the end of the day, I gained $4 for selling that item, okay? And that's the main goal of sales. We want to make those kind of sales. We never want to sell at cost value, because then our business will never make money and will never create a profit, especially when we're dealing with not just solely only the cost it took us to purchase the items, but we also have to deal with the cost of operating or conducting business, right? We have rent expense, right? That's a cost of doing business. If I make my selling price close to the cost that it took me to purchase my items, I can very well say goodbye to my company, because I will never make enough money to make sure I can sustain the building in order for me to operate my business, so on and so forth. So once again, I'm not going to require you to know how to even create a selling price, because this is not your job. Your job is just to record the sales, right? You're not the profit manager. You're not in charge of the sales in particular for marketing, for making those selling prices. You're not the one that's doing all that calculations to tell me how much profit I'm actually going to make. That's someone else, okay? That they are an accountant, but they deal on a different type of accounting. We are strictly bookkeeping. All we care is just to record the sale and what happened that day. So of course, when we are looking at sales, we also have to remember we have to charge sales tax. Okay, it is an obligation for the state/local agencies, our governments, that are required to charge sales tax for every product that you sell. Of course, there are some exceptions to this rule, right? Such as food is non-taxable, services are non-taxable, and even if you're a part of a specific group of people or specific group of individuals, you could get a discount or be tax exempt. But for all cases, right, whether it's a specific product that you use I don't know, a daily item that you normally typically use, that's going to be something that must be charged sales tax at. Now, last year it was actually 8.25%, or I think it increased to 3.75%. But for this class, I want to keep it very clean and simple, right? Because it depends on what location you belong in, right? Sales tax is consisting of the state and the local agency that you belong to. And we'll talk more in depthly about sales tax when we dive into QuickBooks. But for now, all I want you to know is tax is going to be, for this class, 8.25%. Okay? Make it easy and simple. So here's our first example of how we would journalize a sale. Okay, so the example here is that on June 1st, 10 items were sold at $9.99 each. Sales tax was 8.25%. All right, so how are we going to record this sales? So we're going to be taking a look at two accounts: sales and sales tax payable. Pretty straightforward, okay? And of course, right, we also have to think about, how did we get paid? Did we get paid in cash? Did we owe somebody on an account? Right? Or did someone owe you on an account? Okay, so in that sense, then those are the only two options you have, is either a cash sale or a credit sale. Okay, so people either owe you money or they actually gave you money directly. Okay, so once again, sales. What kind of account is sales, or what type of an account does sales belong to? Okay, so it's not accounts receivable. Sales. It's definitely not a cost of goods sold. What are the 5 different types of accounts?
Assets, liabilities, equity. It's revenue.
Revenue. Good job. All right. So yes, it's our main core operating section of the business that allows us to earn money. And that's exactly what a revenue is. So in this kind of concept, what typically increases our sales?
Sales tax.
Okay, on the debit or credit side. Let me add that in there.
Sales would be on credit.
It would be on credit because you're increasing a revenue, which in our concept, we understand that we need to increase it on the credit side. Now, what is a sales tax payable?
It would be
Debit?
Okay. It will not be a debit.
no, it would be a credit.
It will be a credit. Why? What's the key word in this?
Sales.
Okay. It's not directly correlated with sales. Okay. Let's look at the account name. Sales tax payable.
That would be a liability. It would be a credit, right?
Correct. Why is it a liability? Is sales tax your money?
No, that's why it's a liability instead of a revenue.
Correct, because it's money that customers pay you to pay the government. Okay? So it's not even your money. So there you go. We associated two of these accounts. One is a revenue, one's a liability, and we know that these two are going to be on the credit side. So therefore, when we sell an item, when we receive the money, that's going to be a debit because we're going to increase our money. So let's take a look. So if I sold 10 toys at $9.99, how much is my total sales?
$99.90.
Yes, $99.90. How much is my tax on top of that?
$8.24.
$8.24. And that's exactly what we're going to be looking at, right? I didn't specify exactly how I receive the money, right? So it could be either cash, checking, or even accounts receivable, right? If customers owe you money, they put it on on an account. Then you could receive it as an accounts receivable. Here we notice that my sales is going to be from the 99.90, right? Tax is going to be the 8.25% off of the entire sales amount. So 99.90, oh, too many nines, multiplied by the 8.25% should give you $8.24. So in grand total, how much cash should I be receiving?
$1,008.14.
108.14. Okay. Now let's take a look at this. Why are we separating it here? Why are we separating it here? Why do we need to separate our tax with our sales?
Well, they're in two different accounts. One's liability, one's revenue.
Right. The money that we actually earned is going to come from our sales, right? But a portion of that money is going to go to us having to owe the government because it's our duty for conducting business is that we must collect sales tax and, pay it to the government. Okay? So that's why in our books, we have to keep it separate. But can you tell me when a customer gives you money, are they going to give you $9.99 for the sales and they're going to count you $8.24 for the tax?
No, the cash register will total it for you.
The cash register will total it for you, plus the customer's just going to give you a wad of cash and be like, here, give me the change, right? So in your books, that's why in our type of books, we must keep it ourselves separate because that money's not all ours. A portion of that money belongs to the government. So here in our books, we must separate it. But when you're doing business in front of a person, like a customer, right? You're not going to count $8.24 and put it in a little tip jar and say this is tax. No, you're not going to do that. So that's why I'm trying to say in real life, no. In books, yes, you must separate the tax away from the actual sales itself. Okay? So that's how you journalize it. Any questions?
No.
That's
At the end of the year, they have to pay that sales tax to the government, don't they?
it depends on your organization. For small businesses, you have up to 3 months. It's every quarterly for small businesses, not every year. Okay? And then for corporations, it's every week. Okay? So it really depends on how much sales that you encounter. So for example, someone like Walmart, do you think they can get away with paying sales tax at the end of the year? No, they sell billions and billions of items. They have billions of dollars. So the government's going to go after them first. They're going to go after them every week. So we'll talk about that. I believe we talk about that in QuickBooks. There's a section for the sales tax that you must make your payments or else you will get fined. Okay, so little side note, but that's it. That's all you have to do. Any questions? That's it. So here, under the periodic inventory, we do not need to update our inventory. Why?
We're not doing nothing with inventory. We're just taking the cash amounts.
It's just one sale for the moment, for the day, or for that moment. Where
Okay, good. Now, what is required when we calculate our periodic inventory? What happens at the end of the given period?
Conversion?
We do the conversion, and the conversion tells us what?
How much is left over and how much actually has?
Exactly. It tells us exactly how many items we sold. So in this case, we don't need to keep track of what we sell, or we do, but we don't calculate or update our inventory because at the end of the given period, someone's going to go down there and take a physical count, and we're going to assume that anything that is not there, we sold. So at the end of the day, at the end of the given period, we already calculate how many items we sold. Okay? So there's no need to do it. But hold that thought, because when we visit perpetual inventory, we will need to keep track of everything that we sell, everything that we purchase, and everything that we're gonna have to constantly update our inventory. But for now, periodic inventory, no, we do not need to keep track of our sales. Only journalize our actual sales. Okay. So, of course, that was 6.1, just recognizing sales. It's the straightforward, the most easiest concept to understand. We receive money, we got sales, and we charge tax. Boom, that's it. Okay. Now, we're going to dive into 6.2. Well, what happens when a customer decides to give us a return? So, of course, when we talk about having sales, we also have to know that not every customer is going to be satisfied with your product. Not every customer is going to, maybe it was too expensive, so they're willing to return. So there are many, many reasons why a person would want to return an item, okay? Other reasons could be, I bought this item, I plugged it into the wall, it doesn't work, it's defective, it's broken, right? Another thing is, I don't want it anymore, right? A lot of people who buy gifts for each other, what do? Oh, I don't like this gift, so I'm going to go ahead and return it. So there's many reasons why that a customer can return an item. Okay? So with that being said, we must know that if we have the potential for a sale, we have a potential for a customer to return the item to us. Now, of course, we can't just have a customer walk into our door and just return anything that they want to return. We have to create a company policy, because if we allow our customers to have unlimited returns and unlimited discounts or whatever it is, they may take advantage of you, all right? So again, the whole purpose of our sales is we want to keep those items sold. We don't ever want to have those inventory items come back and then resell them, bring it back, resell them, etc., etc. So we need to create some kind of company policy to let those sales either be, final sales, there's no returns or refunds about it, or we need to create some kind of company policy to keep our items sold, all right, so that we can gain our profits whenever we need to. So what are those typical things? So once again, store credit. Oftentimes, a lot of companies, instead of you actually returning the money and they refund the money to you, they'll keep you around by giving you a store credit card saying, hey, I can't give you your money back, but I'll let you keep shopping in my store, right? That's one way of, trapping your customer from, because they already purchased something from you. You can't let them leave without, buying the same product from your store. Okay, that's one way you could do it. Another thing that you could do too is final sale, no returns. You can issue a new product. Oftentimes that's what happens, right? Or you could do exchange policies, right? I'll let you return this item if you exchange it for another item. 100%, as long as it's within the same value price. Okay? Now, of course, if we charge sales tax, we must refund the sales tax, because again, that money does not belong to us either. If the customer paid their dues and paid the government, then and they want a refund, you are obligated to give their money back. Okay? You cannot keep their sales tax for any reason. All right. Once again, it's not your money, and it's also the government cannot take that money from them if they did not properly have a sale going on. Okay. So those are a few things. So most, most sales returns, right? They give you the standard 14 days or 7 days, or if other places like QVC, right? They let you go as far as 90 days. Until they let you use the product until it's completely done, and if you're completely unsatisfied for the next 3 months, you can return it. But other than that, you need to have a company policy to keep your items sold. Okay? Now let's take a look at this. So here is where we're going to do. When we're dealing with periodic sales, right? If we have the idea that we don't even care about keeping track of our sales, and the only thing that we're dealing with is just recording the sales itself. So let's practice this one more time. So here on May 1st, okay, you sold 50 coffee mugs for $5 each. Sales tax was 8.25%. And customer A decides to pay with cash for these mugs. Record this transaction. So, once again, what did we receive from the customer?
Cash.
We received cash. That's our first thing. How are we going to recognize our good? We got sales, and we got what? What's the other account?
Sales tax payable.
Sales tax payable. Excellent. So, how much is just my sales alone? $250. What is the tax based off of the $250 that you sold? $20.63. So in grand total, how much money am I supposed to be receiving from customer A? $270.63. So once again, we recognize that we need to just tally up how much the total cost or the total price of my of the sales. Then whatever total amount I have on my items that I sold, I calculate the tax on top of that. Then I add up those two numbers together to get my grand total of cash that I received. Okay? All right? So let's look at scenario number 1. So then on May 10th, customer A decides that they want to return 10 of those coffee mugs because for a full refund, okay? And your company's return policy is a full refund within 15 days. Okay, so how are we going to record this transaction? So here, they meet our company policy, right? We said, you know what, we'll give you a refund as long as you return it within the first 15 days. So they returned it, I believe, 5 days later. So how am I going to refund them?
Sales returns and allowances.
Sales returns and allowances. Now, we need to create a contra account for the reason of because sales is finite, meaning a sale cannot be changed because it's part of the going concern assumption, right? Assumption. We have to continue doing business as usual. And the one thing that's a main core operations is a sale. So that is one of the things that we have to know, that we have to keep our sales going. It must be consistent. Sales cannot be reversed, all right? Instead, we have to create a contra account to reduce our sales, okay? And that's what a sales returns and allowances account is. It's a contra account to your sales account. And in this case, we are undoing it, so because it's a contra account. If my sales was a credit account, then my opposite contra account would be a debit account, okay? So boom, we got sales returns and allowances. What else do I need to return?
The sales tax payable.
You have to give them back their tax. And lastly, you also have to give them back their cash. All right, so let's calculate this amount. If we originally sold them for $5 each, right? Each mug. And they come back and say, I want 10 of those back. I want to return 10 of them back for a full refund.
50.
It's going to be $50 for the sales, returns, and allowances. Now, how do we calculate the sales tax?
$50 times 8.25.
Correct. We're going to give them back the money based off of how much the total sales is. In this case, we're refunding $50, so we're going to tax the $50 to give them their amount of tax to give back. We're not going to take what they've paid in already. We have to prorate it and find out how much sales tax is based off of the $50 that we are returning. All right, so therefore, we have all that. We added up together to get a grand total of $54.13 back in cash. Okay, $50 for the return on the bugs, $4.13 for the tax. And they're going to get cash back. All right, so any questions here?
Nope.
Okay, once again, this is also straightforward. Okay, so there you go. Okay. All right, so let's look at scenario number 2. Okay, scenario number 2 says that here on May 18, the customer wants to return 10 coffee mugs for a full refund. Okay, however, the customer doesn't like the color. Okay, and you tell them that the customer has actually missed the return policy date. So because they're being really loud and they're being really mad and they're just angry at us and they're demanding a full refund, we want to calm them down and say, hey, you know what? To keep you satisfied, how about we give you a 50% discount off of these items. I'm sorry you don't like the color, but you already missed our return policy, so unfortunately, we can offer you one additional thing, and that's to give you a 15% discount. And of course, the customer is going to take it, right? So, how are we going to compute this time?
Quick question.
Yes.
So you said discount on a purchase, or like, okay, maybe I'm overthinking it, or just a 50% return or refund to the customer?
Who are we dealing with?
We're dealing. No. Okay, so I'm dealing with Karen. Trying to say, are we giving her just because she didn't like the color, even though she saw the color? And of course, if I was a manager, I'd be a complete D. So are we giving her 50% discount of her original purchase, or just 15% on what of course, the 10 cups?
The 10 cups. Because she's trying to return it. But in this case, we didn't even associate customer A was a she or a he. But okay, well, let's go with she. Okay, so she...
Oh, no, a dude would have been like, oh, well.
Okay, yeah, but for small companies, yes, you can get away with it. Now, if you're a major corporation such as Walmart, Target, they don't care. They don't want to deal with the customer. So they're going to say, you know what? I'll give you your money back. I don't want to deal with you. We're a corporation. We have a bunch of money. You want your money back? Here you go. I don't care if you use the product's broken. What happened to the product? Nothing happened to it. Okay, you don't like it? You don't like that color? Here. They don't even look at their own company policy. It's really funny. They just say, okay, you're going to return an item? Okay, let me check it. Okay, boom, here's your credit. They don't want to deal with you. So that's exactly why in this case, I don't want to deal with this person because they're yelling at me. So you know what? I'm going to give you a 50% discount and that's it. If you don't take it, then you can leave. And in this case, she's willing to accept it because that's the case. When you're a small business, you can haggle, okay? Little fun fact here, only small businesses can haggle. If you're a corporation, you have to follow whatever company policy you're supposed to follow or just give them their money back. Either or, you definitely don't want to do this, especially for customer service. You want to be on their good side. So even if for something like this, it's a small company, we are allowed to bend the rules and say, you know what, I'll give you a 15% discount. Okay? And yes, you are correct. It's only off of what she's trying to return. So in this case, she's only returning 10 cups. Okay? We're telling you, you know what, you can keep the items, but I'll give you 15% discount, or I'll give you 15% of your money back because I'm sorry, you don't like the colors, you know? But you know what? You could still use it. There's nothing wrong with it. You missed the discount period, or sorry, you missed the return policy date. I can't do anything about it. So now you're, you know, you're trying to keep their customer satisfied by saying, you know what? How about I give you a special discount for 15%? So how are we going to journalize this time?
It would still be under sales returns and allowances for the 750.
Correct. For the 750, how did you calculate 750?
Because I did 15% times the 50.
Okay, good, because each cup was $5, 10 times 50, correct. And then how much tax am I going to refund back to customer A?
62 cents.
62 cents. So once again, you are correct. But in this context, right, this is going to be served as an allowance. Okay, so this is a credit, right? Because we want to keep this person's, you know, we want to keep them as a customer. So we're giving them an additional discount or an additional thing to kind of either apply it for the next invoice, or in this context, I want to keep her business. So I'm giving her an allowance. I'm giving her a credit, but I'm not giving her a refund. She's attempting to return the item, but I said no. So this is going to be considered an allowance. So correct, you got the sales returns and allowance. And correct, you got the sales tax that you have to give back, and we're going to give back cash. So how we calculate that was exactly how Alan said. You're going to take the 10 items. You're going to multiply it by the original purchase price, which was $5 each, to get you $50. Then you're going to take the 15% off of the $50 to get you $7.50. Then you're going to take your tax off of the $7.50 to get you 62 cents. So in grand total, I'm going to be paying customer A back $8.12. So she essentially almost got 2 cups free. Okay? So with that kind of this idea, so we kind of understand how sales works. Sales is pretty easy, right? Okay? We understand where the tax comes from, what amount of tax is going to be. It's going to be based off of the total selling price, or whatever amount that date you sold. It's not going to be based off whether you sold the item or not. It's going to be based off of whatever cash that was, you know, given to you. Okay?
Quick question.
Yes.
Okay, maybe I'm overthinking it again. So we were refer this to like a credit receipts or a transaction number. I mean, I understand right now we're going date, description, debit, credit, but we'll refer to like this credit on this day.
Oh, yes, absolutely. Absolutely. For the description, yes. You're going to say, this is customer A. Okay, so customer A did this. Yes, yes, yes. But in this context, I just want to make sure that you understand the journal at large. Like, what are the accounts that we're using? The descriptions will come afterwards. You can put whatever you want information in there, whether it's if you have a sales receipt number, place it in there. Okay.
Okay. All right. Yeah, I'm overthinking it again. I'm like, I ain't giving no one a discount. Please, you bought it.
I'm just exercising the understanding of the difference between a sales return and a sales allowance. Okay, so when you're a small business, you can give those additional discounts. Okay. So of course, yes, go ahead.
Well, no, I was looking at that, and on my wall here, I have the accounting model.
Uh-huh.
And as I'm sitting here, this is like a perfect example. You can look at this and look at the accounting model. Like, say, for instance, your assets, okay, are in credit, which is a negative.
Uh-huh.
And then since you have a liability and a revenue,
Mm-hmm.
they're in the debit because they're a negative, because
Correct.
you're losing this. And
Mm-hmm.
I'm just looking at this, and it's like, I think that's pretty cool.
Okay. Yes. So once we actually start diving into our actual fictitious business, we're going to be primarily journalizing every single transaction. So that accounting model will come in handy. Okay. Right. Exactly. You're using that. When we made a sale, we increased our cash, so we debited it. We increased our sales, so we credit it, and we increased our liability because they gave us money that we don't own. There you go. Use the accounting model. That's exactly what it tells you. Okay. So that is how you deal with sales returns and allowances. Any questions?
No.
All right. Last section here is 6.3 sales discounts. So, of course, the whole purpose of selling your items is that you want customers to come to your store and buy them. And the best way to entice your customers is to have a discount. Because one thing you guys need to know about a customer is no one's willing to come to your store and pay full price. They will only come to your store if there is a discount offered. Now, as much as that's just the reality of how the business cycle works, right? You want to sell something, you go out and display that you have a discount off here, and they will come pouring into your store. So how do you entice your customers? Obviously, you have some kind of marketing, right? Have some sort of promotional sales, right? For example, grand opening sales, right? Maybe there's a store-wide sale, or maybe you have an online discount code, etc., etc. Any way to just get your sales going, right? And the best way to do that is to have a sales discount. Now, of course, we're going to be looking at two different types of sales discount. One that is implied in a store-wide location, or one that's actually offered to individual people, okay? All right, so when we look at that. Now, of course, sales, right? You're not taking a discount off the cost. You're taking the discount off of your selling price, which is your profit margin. So make sure that you understand that you're not going to be affecting your inventory whatsoever. You're not going to take a discount off of your inventory. You're only taking a discount of your profit. Okay. Now, again, if you have something that's supposedly sold at $50, right, and it's been 6 months and it's still sitting there, then you're gonna have to think, okay, how about I have a 40% off discount, and maybe people will come and buy it. And what do you know? Usually, if there's something like that, people are more likely to be willing to come in and buy that item for you, especially when you're dealing with, especially grocery stores, right? Every week there's a sale because if they don't sell their stuff, they're going to have to throw it out anyway because it's going to be rotten and all bad. So that's why they kind of do that kind of thing to get rid of their inventory, whatever way to get their stuff out the door and ensure the money's in their hands. Okay? So with that being said, let's go ahead and take a look at the first example, which is a in-store wide kind of sale. So for this example here, we are taking a look at on June 1st, your store had a promotion on all items are 40% off. Okay, so that means, so a customer buys 10 baseball hats, okay, with cash. Okay, which originally the purchase price, which the original selling price is for $10 each. Okay, sales tax is 8.25%. Record this transaction. So now we're dealing with another factor. How are we going to journalize this?
cash and then sales discount.
Correct. It would be cash and then sales discount. So, yes, that's correct. Now, if this isn't making any sense to you, I want you to, the next time you go to the store and there's a sale going on, I want you to read the receipt very carefully. What you're going to notice is that every item on the receipt, it's sold at its original price value. Then at the either at the top of the item or at the very bottom, you're going to see another line item called sales discount. And it's going to subtract the money from the original purchase price and lower the amount of cash that you're supposed to pay. So take a look at your receipt because your receipt is a perfect example of this journal right here. You're gonna have to create another contra account because what does a sales discount do to a sale?
It reduces the cash that you're getting,
Correct.
but you can't discount the sales tax.
Absolutely, that's correct too. You cannot discount a sales tax. And what the sales discount does is it actually reduces your sales. Okay? So here we have the perfect journal. So let's go ahead and calculate each one. So if I sold 10 baseball hats at $10 each, how much is my total sales?
$100.
$100. Okay? Now, if my discount is 40%, how much is my discount going to be off of the 100 items? Or $100? $40. Okay? So therefore, how am I going to tax my items?
On the $60.
On the $60. That's correct. Not on the $100 because how much did you actually sell? You just sold $60. Exactly. You can only tax on things that you sold in the store, right? Based on the selling price. So in this case, I only sold $60, so that means I can only tax $60. So, yes, all of that's correct. So, here, we first have to solve the sales first, right? We need to know how much we're supposed to be getting. So 10 times 10 is $100, right? You take the discount because it's always before tax. Tax always happens afterwards. So the discount is going to be applied only on the selling price, which we know is on the $100, or you could take the discount off the $10 and then multiply it by 10, same thing. But in this case, it's easier to just take the $100 and discount it at 40%. So that gives you $40. Okay? Then we're going to tax the $60 because that's how much we actually sold. Is $60 worth of baseball hats. So I'm going to tax it at $60 to get me $4.95. So from there, how much cash am I supposed to be receiving?
$64.95.
$64.95, right? 60 for the actual sales, $4.95 for the tax. Okay, correct. Okay, so again, any questions in regards to the in-store discount? Okay. All right, so again, this one's also straightforward, pretty easy. Okay, so let's take a look at when we are dealing with an individual, right? We've seen what terms are. Okay, we all know what that is, right? What's terms?
Restrictions?
No, it's not a restriction.
Like you'll give a discount to someone if they buy in bulk.
Okay, it doesn't have to be necessarily if they're in bulk, but let's say you have a person that decides to place their order on an account. It's an incentive for them to pay you back faster. Okay?
It's like an agreement.
It's like an agreement. It's like an agreement, but it's also a special offer because again, if someone's going to owe you money and you give them an incentive to say, hey, if you pay this whole thing off within, 5 days, I'll go ahead and give you a discount off of the things that you bought. Because one, not only are you giving them an incentive, you're getting the money back quicker. Okay? Because they owe you, right?
This is just like we did earlier.
Correct. Purchase discounts and sales discounts for this particular thing is applicable for both. You can have terms for a vendor. You can also reverse and say, hey, I'm the vendor now. You're my customer, so I'm going to offer you a discount if you pay within 15 days. But if you don't, then you're going to have to pay in full in 30. So basically the terms is applicable whether you are the vendor or you're the customer. Okay? So you can use it for both purchases and for sales. But in this context, instead of a purchase discount, this is a sales discount. Okay? So let's take a look at this. Example here on July 1st, okay? A customer wants to buy in bulk, all right, 100 baseball hats, okay, from you, okay, on an account. Okay? And because this customer is a first-time buyer, you offer them you offer them terms in which 5%, they get a 5% discount if they pay within 15 days. If not, it's due in 30. Okay, so 5% net, 5%, 15 net 30. Okay, each hat is sold for $10 each. Okay, sales tax is still 8.25%, and there's a delivery charge for $10. Record this transaction. So we're looking in context of selling an item to my customer. However, we won't give them the discount until they pay us. So let's just record the sales first, because that's exactly what this discount is for. It's only if they pay us. And we haven't recorded their payment yet. We're just only recognizing that they purchased something from us, or we sold something to them. Okay? So how am I going to journalize this transaction?
July 1st, you would go with accounts receivables since it's on account.
Correct.
Then after that, you'd have your sales. You'd have your sales tax payable. And
Okay.
your delivery charge.
Correct. All that's correct. Okay? Because here we're not going to recognize the discount yet, because the discount has a condition. They have to pay. And if they don't pay, they don't get the discount. So in this case, it's on an account. I recognize that I have my sales. I recognize that I have sales tax. And I also tacked on a delivery charge on top of that. So here, if I sold all of my items, 100 hats at $10 each, how much is my sales? Go ahead.
So their delivery charge is not taxed. So this ain't like California, Oregon, or Washington, where a service is taxable. It's just like here in Nevada. I'm just using this as an example. A delivery charge is kind of like freight charge, not applicable to taxes.
Okay. I've never really seen a delivery charge get taxed. Ever.
Oh, we did, yeah. Well, I did transportation. We did that a lot too.
Okay.
Yeah.
Um,
That's the only reason I'm asking. But I did have the equipment.
usually
Delivery fee.
Usually delivery fees are just a flat rate. It's not okay. Usually it's just a flat rate. But if you charge, you might be if you're the third party vendor, then you can charge tax on that because it's your service. But if it's the same company, then usually the delivery charge is a flat rate. So I think if you're thinking in the context, if you're the third party vendor, then yes, you can tax for having the delivery done. Yes, absolutely.
Okay.
But in this case, I'm assuming that me and my company were one person, so I'm just going to charge a flat delivery rate of, what did I say? $10?
$10.
Okay? Yes. So in this case, I do not tax my delivery. It's just a separate extra charge. Okay? So what's my total sales?
1,000.
1,082.50.
Okay, so where did you get the 82.50 from?
I took the tax times 1,000.
Perfect. Okay, so that's okay. So sales, right? We're just looking at how much I'm earning. Okay, tax is yes, good, 1,000. The 82.50 is going to be what your tax is. Okay. Now, if I'm going to add my delivery charge, what should be my total amount that they owe me?
1092.50.
1092.50. So once again, you have your sales for 1,000, you have your tax for 82.50, and you have your additional $10 delivery charge to give you a grand total of 1092.50. Okay? So now we're looking at scenario number 1 here. Let's say this customer comes back and says they make a payment on July 12th. So the customer pays in full. Okay, so how are we going to record this transaction? Because they were within the discount period, right? They paid 12 days later, right? Because they purchased it on the 1st. They paid 12 days later, which made it in within the 15 days. So how are we going to distribute this 5% discount? So let's break it down first for each one.
Well, the 1,000 times the 5% would give you $50.
Okay, good.
So I guess start with cash and then sales discounts.
Okay.
Then you would do the sales tax payable on only the not the 50, but the other, the 1,000 or the 950. Or wait a minute.
So in this
I'm doing the
case,
math in my head, I'm sorry.
no worries, no worries. So in this context, right, you figured out that $50 was the discount. It would be much easier if you just calculated the money that we have to refund back to the customer versus then finding out how much tax we're supposed to be collecting from the vendor, because that's exactly what you just told me.
Okay.
So in this case, how much am I actually giving back for tax?
Wait, you threw me for a loop there. So are we going with on the 12? We give him the $50 back, and then we give him the tax off the $50.
Correct. Correct.
Okay. Now journaling, I would pay attention because this is where I'm like, I understand the $50, and then so we'll give him the taxes, which is what.
You would do the sales tax on the cash after the sales discount.
So we'll give him $4.12 back in taxes.
$4. It should be 12.5 cents. So we have to round it up.
Oh, okay.
So $4.13. Yes, because in this context, right, Alan? I'm giving back their money, right? Because they got a discount. Because I already charged them in the first place. So if I charge them the tax off of the $1,000, then how you're calculating is you're supposed to take the tax off of the discounted item, which is whatever, $9.50, right? That's how much we're going to charge them. We already charged them the money. So in this case, remember, we charged them $82 worth of tax. So if we have to give them back their money, we have to give them back their tax. So once again, you are in your concept, you're calculating how much tax we're supposed to receive. We've already done that. Okay, so let's take a look. So Felipe said that you have to do $4.13. So go ahead on a separate sheet. What's $9.50 times your tax?
923.50.
$950 times 0.0825 is a lot higher than
Did
39.
I get $78.38?
Say that again. 78, 30, 38. Is that what you got?
Yes.
All
Am
right.
I correct?
That's correct. Now,
Okay.
what's the difference between the 78.38 and the 82.50? Oh, go back one, sorry. What's the difference between that?
Yeah, 82.50. Okay.
What's the difference between the 82.50 and the 78.38?
The 413.
413. That's so either way, when you calculate it, you're still getting the same answer. In this case, I already charged the sales tax, right? I already charged the sales tax. Now, in this case, I'm giving them a discount, so that means I'm refunding their money. So therefore, the easiest way to understand this is how much was my discount for? How much money am I giving back? $50. So how much is tax off of that $50? $4.13. Okay, this right here is the money that we're going to refund to him, right? The $54.13. Okay, that's the discount right there, because not only am I applying the discount, I have to give him back his money because I didn't sell 1,000. I only sold 950. So that means the 78.38 is all the money that I'm actually collecting from this cash. Which, go ahead, calculate it. What's 950 plus the 78.38? Or in this case, 37. Wait, 30. What did I say? 38. What did I say? 950. Okay. Plus your. Yeah, that's right. I should get $28 and 38 cents plus the $10 for the delivery fee. Right? Add $10 to that, that's $10.38.37, because we have half a penny. We have to either round up for our sales, or in this case, if we're following the conservatism rule, we'll always round down for our sales, right? We always take the lower end of the stick. So in this case, you see here, even if I calculated how much we're supposed to be receiving, you'd still get the same answer for the amount that you are being discounted for and the amount of tax you have to refund. Because once again, that $82.50 is not your money. Okay? Are you okay with this one?
That one's fine.
Okay. I didn't know. You were very quiet. I didn't know whether.
I'm sitting here. I was just doing the math in my head, and I came out with the same answer as you did, and so.
Yes.
But
Okay.
yeah, I understand though. I understand completely.
Okay.
No,
So
I'll stop a couple, but I had when you said the last one, you got round, or you know what I mean. So yeah.
yeah, in this case, it's just because that dangerous thing about having half a penny. You either round up or round down for one of them. Okay. So in this kind of context, you always round up for the government and you always round down for us. Okay. That's the conservatism, conservation constraint that we have to learn. But in this case, tax is always going to be rounded up, no matter what case it is. Tax will always be rounded up. Okay. So there you go. Now we should have a grand total of cash to be received for $10.38 and 38 and 37 cents. Okay. So that is how you deal with a customer that receives a discount. So once again, here's the chapter review. We learned chapter 6.1 is we understand how to record a sale. Pretty straightforward. You receive cash, you are going to calculate your sales. If there's tax involved, you're going to calculate your tax. Okay? Then we dealt with what happens when a customer is unsatisfied and they make a return. Then you're going to create a sales return and allowances. You're going to credit however they paid you. If there's tax, you also have to give back the tax. In this case, I didn't have tax. And then if you give them a discount and they're attempting to return, but you said no, you still use the same thing. If you give them a discount, you're going to have to calculate your allowance here. Okay, so it's just like the purchase returns and allowances, except this time we're applying it to a customer. Okay, another thing you need to know is you cannot take a discount off of shipping, tax, and I think that's it. All right, then we're looking at discounts. So this is where I was talking about discounts. Discounts. One idea is when we do an in-store discount, right? Usually it's applied to everybody. Anybody can get this discount. So therefore, you're going to recognize that your cash is going to be lower because you have the discount. But you're essentially what you're trying to do is you're trying to discount the selling price itself, right? Recognize sales tax if there's any. And then here, when we're looking at a customer standpoint, if they have it on account and you give them terms, they have a condition they must meet in order to get the discount. They have to pay first. And then you can determine whether they deserve the discount or they don't get the discount. All right? So one thing here is they have to pay, because if they don't pay, they won't get the discount. Okay? And then once again, you cannot take a discount off of delivery charges or tax, okay? And of course, when you do take your discount, they will always be taken off first, and then you'll charge your tax after that, okay? And again, sales are all recorded at full price, no matter, even if you have the discounted price on there, you must charge at full price, then take your second line item or take your contra account to count for the discounted amount, okay? All right, any questions in regards to chapter 6.1 through 6.3?
No.
Okay, so we have 30 minutes. I'm kind of debating, is that enough time for us to finish this little exercise? So, I mean, we can get started. If we don't finish, we could just finish it up tomorrow. Okay, so here we are. If you guys have this, follow along with me. So chapter 6.1, 6.2, 6.3, periodic inventory sales, okay, and sales returns and allowances. So let's take a first one. So here we're going to journalize, okay, assume that all sales tax is 8.25%, okay. Starting from the very first one, on April 5th, you sold 100 cups at $5 each, okay, to customer A, okay, for cash. So how are we going to journalize this?
April 5th,
Mm-hmm.
Sorry.
Cash.
Yes. What did we receive from the customer? Cash. So always, if you have your accounting model, are you increasing your cash or are you decreasing your cash? In this case, we're increasing because we sold something. We're getting money for this. So therefore, we're going to debit our cash account first. Now, are we increasing our revenues?
Yes.
Yes, we are increasing our sales, so it must be on the credit side. And last but not least, what do we also have to tack on here?
Sales tax.
We need to also charge sales tax, right? So let's calculate it. So if I sold, okay, 100 cups at $5 each, how much is my total sales?
500.
It's going to be $500, okay? How much is going to be my tax?
500 times
41,
25.
41.25. Okay, so again, it's 500 times the 8.25%, or in this context, 0.0825, to get you 41.25. And again, we round up. So $41.25 should be your amount of tax. So how much cash am I going to be receiving?
541.25.
541.25. Okay, and here I'm going to make a note just in case customer A decides to turn around and decides to return something. So I'm going to make a note that I sold 100 cups to customer A. Okay. Oh, okay, no, this is not Excel, right? So, good. That's the first transaction there. So then what happened on April 7th? We sold 25 cups, okay, for $5 each to who?
Customer B.
On account. So here, we're going to give customer B terms. We're going to say, hey, bud, I'll give you 10% discount if you pay me back within 15 days. If not, your entire bill is due in 30. So how are we going to journalize this?
Receivable.
Accounts receivable. So good. Receivable. Okay. What am I going to recognize here?
On accounts, you didn't receive the money yet, so wouldn't it be sales?
Yes. What is the transaction at hand? We sold something to a customer on an account. Good. So the transaction at hand is that we sold something. So we're going to recognize sales. What else?
Sales tax payable.
Sales tax payable, right? We need to charge them for them to get an amount that they owe us. Then if they pay us, we can counter against it to solve if they have a discount or not. So in this case, we're recognizing the transaction at hand, which is just the sales. Okay? So if I sold 25 cups for them at $10 each, $5 each, what is my total amount that
25.
it'd be 125?
Yes.
All right, how much tax is going to be on top of that 125?
$10.31.
1031. So how much does customer B owe me? Excuse me.
$1.35.31.
$1.30.
35.
That's fine. 135.31. Excellent. So here I'm going to make a note because customer B decided to place on an account. So I'm going to say sold to customer B. All right. And here I'm going to say I gave them a 10% discount if they pay within 15 days. Okay. If not, they have to pay me in full within 30 days. So I'm going to place my terms there. Okay, just so I have a reference point for when I do my next transaction. Okay, and if they pay me, I can always look up that transaction. Okay, so let's take a look here. What happened on April 10?
You sold 50 cups at $5 each to customer C for cash.
Okay, so we have another cash sales here to customer C. We sold 50 cups at $5 each to customer C for cash. So what am I going to recognize here?
Cash.
You're going to recognize cash. So this is April 10. We received cash. All right. What else did we do?
Sales.
Yes, this is a sales, right? And what else do we have to include?
Sales tax.
Sales tax, correct. Okay, sales tax payable. Okay. So if I sold 50 cups to customer C at $5 each, what is my total sales?
Dollars.
$250. Okay. How much is my tax off of those 250 items? Or $250?
2063.
2063. So what is my grand total cash I received from customer C?
$270.63.
$270.63. Good. Okay. And I'm also going to make a note here that I sold to customer C. Okay. Just in case he decides to return something for me. Or just in case he decides to return. All right. So then what happened on April 15?
Customer A returns 10 cups for a full refund.
Okay, so customer A decides for a full refund. Okay, we grant it the full refund, right? Because it's only been what, 5 days? Okay, so how are we going to recognize this? Is it April 15? Yeah, April 15, customer A returns 10 cups for full refund. So how much? So what are we going to recognize first?
Sales, return, and allowances.
Yes, sales, returns, and allowances. Because once again, who are we dealing with? We're dealing with a refund for a customer. Okay, so returns and allowances. Okay, what else do we have to give back to the customer?
Sales tax.
We have to give them back their sales tax. All right, lastly, how are we giving back the money to the customer?
Cash.
Yes, they originally gave us cash, so we're going to refund them in cash. Okay, so let's figure this out. They're returning 10 cups, right? 10 cups. Okay, at what price did I sell my original cups for?
$5 each.
$5 each. So how much for just the sales, returns, allowances? How much am I giving back?
50.
$50, all right? How much tax off of the $50 am I giving back?
$4.12.
It should, yeah, $4.13. Yes, it's 12 and a half. Okay. So in grand total, how much cash is customer A going to be expected to get back?
413.
Yep. 54.13. Okay, I heard 4.13.
Oh, no, I said 54.
Okay, good. Okay. All right, so good. All right, and what I'm going to say here is customer A returned 10 cups full refund, right? Because they received a full refund, we're going to get those 10 cups back, okay? All right, so now, what happened next on April 20th? All right, so customer C decides to return 25 cups, but is willing to accept a 15% discount. So customer C is trying to return stuff to us. All right? And let's just say we say no. I don't know why, but let's just say we said no. So they're willing to take a 15% discount. So how much, or what are we going to recognize, and for how much are we going to recognize? So here we're going to start on the bottom one now. So it is now 521. Okay. So what is going to be my journal? What is my entry going to look like?
Returns?
Sales returns and allowances, correct. So sales, returns, and allowances, right? Okay. What are we going to be giving back as well?
Sales tax payable.
Yes, we have to give back their sales tax, okay? Even though they didn't give back the product, they still paid into the sales tax. Okay, so we have to give it back. And how are we going to give back their money? What did we originally sell the customer? How did they pay us?
Cash?
They paid us in cash, so what are we going to give back to them? We're going to give them back their cash. Okay, so let's go ahead and conduct this. So they're attempting to return 25 cups, right? We originally charged them $5 each, okay? But we're only giving them 15% back. So how are we going to calculate this?
125 times the 15%, give you 1875.
1875. So let me see. 25 times 5. Oops. 25 times 5 gives you 125 times the 15%, like Alan said, and we do get $18.75. Okay. How much tax are we going to give back?
$1.55.
$1.55. So in grand total, how much money am I giving back? $20.30. Okay. And I'm going to go ahead and write here that customer C returns 25 cups for a 15% discount. Okay. So then what has happened next on April 22nd?
Customer B received his purchase and he met the discount, so he's going to end up getting the 10% discount on April 7th sale.
Okay. So let's observe. Go ahead.
Now, is that going to apply also for the tax, correct?
Did you say it will apply or will it not apply?
No, it will.
For the discount?
Yes.
No. You can never cheat the government by discounting them. Okay, make sure you know that, okay? Because if they find out that you discounted off the tax, they will come after you.
No, not the tax. So if we discount the total, sorry, I'm going back. I'm reversing. So if we discount the total sales,
Yes.
we discount the tax as well?
No, you can't discount sales tax.
Okay.
Yeah, no. Sales tax is, you can never discount sales tax. Okay, whatever you charge for tax. So if you're saying, okay, I think I understand what you're trying to say. With the discount, are we going to give back the tax? Yes. Yes.
Okay. That's all I'm saying. Yeah,
okay, yes.
Okay,
For some reason, I was able to understand what you were trying to get at, okay? Okay, so oh my gosh, I put the wrong dates. So it is now April 22nd. So because customer B paid for their invoice, right? So let's take a look at how much they owe us. If customer B owes us a total of $135.31, okay, they get to receive a 10% discount off of their original sales, okay? They also, because they pay, or we calculated the tax off of the original purchase price, yes, we do have to give back their tax money because, you know, right now they didn't actually pay yet, but we have to discount them or subtract it out because we've already calculated the tax already. We've already charged them the tax. So now essentially we need to give back the tax. So how are we going to journalize this? So let's take it one step at a time. What are we receiving?
Receiving a payment.
Yes.
Cash.
Okay, so it could be cash. It could be a check. However they're going to pay us. So in this case, I'll keep it simple. They gave us cash.
Okay.
They gave us cash. Right? No. We received money from them. Okay?
Okay.
So we received money from them. Okay? They also received a discount because they paid within terms. They should be getting a 10% discount off of their original purchase, which was, again, we saw up here, which was we sold to him a total of $125 worth of cups.
10% would be $12.50.
10% will be $12.50, correct. Now, because we're discounting that amount, how much tax are we giving back?
$1.03.
Okay, so how did you get that number?
I took the discount price times tax.
Good. So if we recognize that we're supposed to get a $12.50 discount, right? Because our original purchase price was for the 125. 10% of 125 gives you $12.50. Now, because we're giving back or attempting to refund the $12.50, right? In context, right? We're giving them a discount. Then we have to give them the amount of tax that we originally charged them for, which is going to be based off of the $12.50. So, hold on, let me write in my sales tax payable. So how much money are you refunding back for the tax? $1.
I think it was $1.03.
$1.03. Let's double confirm that. Anybody want to do the calculation? Yes, no, maybe so. Okay, well I calculated it already. It is $1.03. Good. Okay, so that's how much tax we're giving back. Now, then we gave them the discount. We gave them the money that they're supposed to be taxed at. How much should we be receiving? Okay, let's recognize first. They're paying what we owe them. I'm sorry, they're paying what they owe us. So in this case, we need to reduce our accounts payable because they don't owe us anymore. I'm sorry, accounts receivable. They don't owe us anymore, right? So we need to decrease it.
$11.47.
And it's going to be, you said 111.47. Is that for the check, for the cash that we're receiving, or for the amount that they owe us?
That would be the amount that they owe us.
What did you say? 11?
Yeah, 111.47.
111.47. Let's try again. They owe us money. What did we originally charge them?
125
Okay, plus tax.
plus tax. Oh. I
Yes.
didn't factor that in. Sorry.
No worries.
Okay, now I know where my. Okay, that's why. Okay.
Okay, so here, what was the original amount that they owed us? Even if they did not pay within the discount period, how much do they owe us? 135.31. So here you always need to know, because we debited for 135.31, you can't just miraculously switch the numbers and say they only owe us this. No, in context, that's not how accounting works. And this makes a lot more sense when we dive into our fictitious business. But in this context, they owe us 135.31, regardless whether they received the discount or not. They still owe us that money. Because now they paid within the discount period, now we have to reduce the amount that they owe us, right? But the amount that they owe us is still going to be the same, because the context here is, did they pay or did they not pay? Even if they paid or not, they still owe us 135.31. So here, now that we recognize that the discount which is going to reduce the sales, it's also going to give back the tax. So then now, what is my check going to be written out for? Obviously, he's not going to write me a check for 135.31. He's going to write me a check or give me cash for the less amount. So how much is the cash I'm going to be receiving? 121.78. 121.78. So you see this? He owes us supposedly 135, but he earned the discount. So therefore, because he earned the discount, he's subject to pay us less. So think of it in that kind of context if this section is kind of confusing. Okay? Okay. They received a discount, so they pay less than what they owe us. Okay? And once again, I'm going to go ahead and make a note that customer B paid in full with 10% discount. Okay? All right, so we reached the end of the scenario. Okay? So does this make sense?
Once we go over it again, maybe it will.
Okay.
For me.
Okay. All right. All right. If you guys don't have any other questions, you guys are pretty much free to go, and we'll see you tomorrow. Tomorrow we're going to deal with chapter 6.4. And then, yes, if you want to practice more sales, we can do that as well.